With the bond market down worse than it has been for the start of the year in over 2 centuries, and the stock market down worse than it has been for the first of the year over the last 50 years, many people are wondering what should they do now. One of the best people to look at as far as what to do now and copy would be someone like Warren Buffett. Warren Buffett has been managing money through his Buffett partnership and through Berkshire Hathaway for over 70 years, and he has a great track record doing it. If you'd invested with Mr. Buffett over the last 70 years, you would have done on a percentage basis about twice as well as the S&P 500. With the S&P 500 earning about 10 to 11%, Mr. Buffett has done about 20 to 21% over that same period. And even as he is managing more and more money and has less and less to buy, is still pretty impressive. But what has Buffett said recently about the markets, and what is he doing recently with his own funds? Mr. Buffett spent close to $50 billion over the last few months, starting in March, buying up companies like Chevron, Occidental Petroleum, also bought up Hewlett Packard and Activision. This article showed up in Yahoo Finance not too long ago, and it talks about the ups and downs of Berkshire stock. It says Buffett would be the first to tell you that Berkshire has seen extraordinary returns over time. Between 1965 and 2017, the company has grown its book value at a 19% average annual rate, and to share price gains of nearly 21% per year on average, which is double the 10% average of the S&P 500 over the same period. Yes, when you look at more closely at the short-term movements of the stocks, they don't move straight up or straight down predictably. As Buffett describes it, stocks surge and swoon, seemingly untethered to any year-to-year buildup in the underlying value. The result is short-term price randomness for stocks, and investors can have no confidence that the price of the stock in the market will bear any connection to its intrinsic value at any given time. Warren Buffett studied under Ben Graham in Columbia Business School and later worked under Ben Graham at the Graham-Newman Corporation. And Ben Graham is known as the father of value investing. And Graham was well known as saying, in the short run, the stock market is like a voting machine, meaning those things that are most popular are going to keep moving up. But in the long run, it's a weighing machine, meaning that those things that are worth a lot are going to move up. So if you want to buy something for a price that's quite a bit below this intrinsic value, and Mr. Buffett likes to figure out what the intrinsic value is before he even looks at the price. So if the intrinsic value is here, the price is down here, then over time this price is going to come up. And if you buy great companies, then the value is going to go up with it as well. So those are the things we want to look at. Despite large gains for long-term shareholders, this company has seen several spans of time during which Berkshire performed terribly on an absolute basis. Some of the worst periods include the following: March 73 through January 75. During that period, Berkshire Hathaway stock lost 59% of its value. In 1987, in October, Berkshire Hathaway lost 37% of its value. From 1998 through March of 2000, Berkshire Hathaway lost 49% of its value. And from September 2008 to March of 2009, Berkshire Hathaway lost 50.7% of its value. So most of those down periods came at times when the market was doing poorly also. From 1998 through March of 2000, there were a lot of things that did extremely well, while Berkshire Hathaway stock did not do well. We all remember the dot-com boom and how the NASDAQ blew up during that period of time. But Berkshire wasn't invested in technology companies. Many people called Berkshire Hathaway a dinosaur because it was stuck in an old economy mindset. Something that Warren Buffett likes to get across is investing within your circle of competence. And it's interesting to note what types of things Warren Buffett is good at investing in. He's particularly good at investing in insurance companies and in banks and in consumer companies. And he's particularly bad at investing in things like airline companies and retail. Now, some may say that it's hard to find really good businesses in the airline and the retail space, and you want to stay away from that completely. But Berkshire Hathaway and Warren Buffett tend to also stay away from technology stocks, at least until he brought on his two new lieutenants that are now buying a lot more technology stocks. Ted and Todd have been buying up a lot of these technology stocks where Warren Buffett may not be as keen on that, except in the case of Apple Computer. He's been buying a good bit of Apple Computer over the last few years. So Buffett has warned investors specifically to expect similar crashes in the future. He noted a few years ago that in the next 53 years, our shares and others of other companies will experience declines resembling those in the table that we just shared. No one can tell you when this will happen. The light can at any time go from green to red without pausing at yellow. The interesting thing, though, is that the Oracle of Omaha does not see these drops as a negative for long-term investors. Instead, for those who have the financial resources, taking advantage of those declines by putting money to work at attractive valuations can be one of the biggest sources of long-term outperformance. For those people that aren't afraid to be greedy when others are fearful, they can put a lot more extra money to work when things are down and try to stay away from taking money out of the market when you're scared and actually put more money to work when others are fearful. Countless times, Berkshire's has been able to use its ample war chest of cash to be a capital source of last resort to ailing businesses desperate for a financial lifeline. Now, Berkshire tends to get favorable terms when that's the case, but he has come in as a savior in many cases. This article goes on. The problem for most investors is that the most uncomfortable time to invest in the market is when it's plunging. Fear of putting money into stocks and immediately seeing further substantial losses can paralyze even the most experienced investors from pulling the trigger on what can become some of their most successful investments. So preparing in advance is the key. If you mentally play it out beforehand, what you're going to do if this happens, if we get things at 50% off, it's good to go and buy because eventually these things come back over time. Warren Buffett has always been able to detach himself emotionally from his investing decisions, and that's been an essential part of his success over his career. Warren Buffett says that the most important thing for an investor to develop is the right temperament. He says that a high IQ may actually work against you. You don't need a super high IQ to be able to invest in the markets. You just have to be able to be greedy when others are fearful and be able to put money to work when things are down and going for 50% off. If you're curious as to what Warren Buffett is doing from time to time as far as what he's buying or even what he's selling, all you have to do is look up the records through the SEC. They're filed under what's known as a 13F in most cases. So when you look at these 13Fs, you can see what Warren Buffett is buying and what he's selling. There's a lot of other good sites where you can go to find out what he owns and other investors own that manage more than $100 million or are buying more than a certain percentage of a company. We've also seen recently that a lot of insiders and CEOs have been buying up big chunks of these companies, and that gives us a lot of confidence going forward. In fact, in the month of May and June, we saw CEOs buying at a clip that we haven't seen in a long time. And usually when they're buying at these high levels, that is good for the markets. Combine that with the fact that most investors are very pessimistic. When we see people like Warren Buffett and CEOs of companies buying when the average person is extremely pessimistic and wanting to sell, that gets us even more excited about buying when others are fearful. That's all we have for today. Thank you for joining us, and we'll see you later.